As 2023 comes to a close, the year 2024 is going to present some new opportunities for both dividend and income investors. This is largely due to the Federal Reserve's announcement back on December 13th, which came with some really optimistic news. During the Fed's very last meeting for the year, the committee members indicated that they anticipate reducing interest rates 3 times in 2024. This news has already created optimism in the market, and stocks have been rising ever since the announcement was made. But what I think is even better is that a handful of investments, specifically those that are known for paying larger dividends, are expected to see bigger share price gains next year. This is after a handful of these sectors have still been struggling to recover while the whole market has seen some good gains in the last year. So in this video, I want to discuss what I think will be good areas of opportunity in 2024 and also what I plan on focusing on more as the year progresses. I'm going to mention a handful of different sectors as well as some specific companies and funds that I think are going to be good contenders for growth. Some of these investments I think will have better potential than others, and I'll mention where necessary that some of them have been struggling over the past year, and I obviously can't guarantee that they'll fully recover by the end of next year. But the following types of investments do tend to do a lot better when interest rates start to get cut or they're already low to begin with. In the coming year, as the Feds hopefully follow through on their intention of lowering interest rates, the sectors that stand to gain the most are the ones that regularly borrow large amounts of money. These companies might do this to either expand or they own large and expensive assets that are costly to upgrade or repair. The first sector that stands to gain more than average that sometimes pays good dividends is the infrastructure sector. This includes both infrastructure funds as well as companies that hold large amounts of infrastructure to carry out their business. Examples of infrastructure include railways, bridges, and assets that are used to provide freight transport. These types of companies often have to borrow large amounts of money in order to repair or upgrade their main assets. So as you can probably imagine, when interest rates are high, this can lead to much higher interest expense for these companies, which has several negative impacts. It not only lowers net income for these companies, but the management teams might decide to hold off on expanding their operations or upgrading their assets, which could generate new business. It's even worse if a company has to refinance a bunch of debt while rates are still high. But with lower interest rates, these companies can start borrowing money and can start expanding and making upgrades for less money. There are a few options that exist for these kinds of investments, although there aren't as many that exist specifically for infrastructure investments that pay dividends. Brookfield Infrastructure Partners, ticker symbol BIP, is a master limited partnership that holds these types of assets. You can see that it's been recovering now that interest rates are expected to start falling. It does come with a K-1 tax form, but it's been a pretty good dividend grower over time. Another option that exists that doesn't come with a K-1 is the Cohen & Steers Infrastructure Fund, ticker symbol UTF. This is a closed-end fund that invests primarily in value stocks of infrastructure companies across all market capitalizations. This is a higher yielding option that exists that does pay monthly dividends, although they haven't been able to grow their distributions like BEP has, who's grown their dividends every single year. Another sector that stands to see gains in 2024 are utilities. These are companies that also need to borrow large amounts of money to grow and repair their assets. This would include energy companies that use pipelines for natural gas, cell towers for telecommunications, and green electric stocks. Whether it's pipelines, cell towers, electrical grids, or wind turbines, these are all again very expensive assets to maintain. Now where it does get tricky is that for a lot of these stocks, the performance of these companies is tied to the performance of the underlying product that they're selling. So for example, with natural gas companies, even if interest rates do get cut, that does not guarantee that things will be easier for them. What has a larger influence on the performance of these stocks is the performance of natural gas prices. So even though interest rates might get cut and pipelines are now easier to finance and build out, if natural gas prices tank, then that's not going to be good for these stocks. The same can be said for all of these companies, including cell towers and etc. If the underlying asset that they sell falls in price, then lower interest rates aren't going to make a big difference, so that's something to keep in mind if you're considering a utility or an oil transportation investment. For me personally, I'm still a pretty big fan of Enbridge in terms of natural gas. They continue to expand their operations, have good free cash flow, and have a long history of consistently raising their dividend distributions. I can't predict the price of natural gas in 2024, but Enbridge is a company that's done really well through a variety of different market conditions. I also think Energy Transfer, ticker symbol ET, as well as Enterprise Product Partners, ticker EPD, are good alternatives if you're not a fan of Enbridge. I also hold the Reeves Utility Income Trust, ticker symbol UTG, which is a monthly paying closed-end fund that holds different utility companies. I will say this fund appears to be struggling to grow its dividend as of recently. They had a really good track record of growing their dividend every 1 or 2 years, but they've been currently going through their longest history without raising their dividends. On another note, the entire REIT sector is still largely undervalued despite modest gains in 2023. This is another type of company that has to take out a lot of debt to acquire more properties or make improvements to their current properties. All of the REIT dividend aristocrats are still trading at discounts, including Triple N REIT, ticker NNN, Federal Realty Trust, ticker FRT, Essex Property Trust, ESS, and Realty Income, ticker symbol O. There's actually one sector of REITs that have gone through a double whammy in our high interest rate environment. They're both a REIT and they hold a utility asset, cell towers. Companies like Crown Castle and American Towers are trading at tremendous discounts still, and both have seen their share prices recover some in 2023, but they still have a long way to go until they return to their historic average. For people looking for a high-risk, high-reward kind of REIT, office REITs are still extremely undervalued. There's still talks of a commercial real estate collapse, but people have been talking about this since 2020. This will probably be the year we find out if this actually plays out, but many office REITs have already cut their dividends, including SL Green Realty. I don't currently hold any office REITs and I don't have any intention to, but this is still a high-risk, high-reward opportunity for those interested. I'm also not holding my breath when it comes to mortgage REITs. These investments are supposed to do much better when interest rates fall, but many of the largest M REITs have continued to fall even when interest rates were near zero. Again, there are some much better companies in this sector, including Arbor Realty Trust and Rhythm Capital, but stocks like Annaly Capital, I'm just going to continue to avoid. One more asset class that does come with a high-risk, high-reward situation are closed-end funds that hold high-yield corporate debt. Some examples of this would include a lot of the PIMCO funds. Ticker PDI, PCM, PTY, and a lot of other funds by this company saw their NAVs fall significantly when interest rates soared. However, once interest rates do start getting cut, then the value of these bonds should increase, and I'm betting on a recovery on these investments. It's kind of a crucial point for the PIMCO funds right now though, because although the dividends were more than covered for the majority of their funds last year, this year their coverage hasn't been as good. So at this point, investors are still waiting to see what the early part of this year will bring, and if PIMCO is going to be forced to reduce dividends on some of their most popular funds, including PDI. Another fund that holds high-yield bonds would include GOF, which is the Guggenheim Strategic Opportunities Fund. This one has been suffering, but up to this point, there hasn't been a dividend cut. Although I don't hold this investment, the incredibly high yield has been really enticing. But with all this being said, these are most likely going to be my main focuses on my portfolio this year. If you're wondering about business development companies, it's my opinion that although this asset class will likely keep growing because of recovering NAVs, I don't see as high of an opportunity in terms of growth. Many BDCs are now trading at their normal price ranges before the pandemic and before interest rates were getting increased. There's currently a handful of BDCs that are still undervalued, but either all of them have payout ratios that are close to 100% or they've seen their NAVs decrease a lot. That would likely cause a lot of investors to be skeptical. I'll still keep buying into these investments, but not as aggressive as I was back in 2023. I also think SCHD will also continue to recover really well since it holds a lot more bank and financial companies, and these stocks also do much better when rates get cut. But this is going to be my game plan going into the new year unless something dramatic happens. Early in the new year, I'm considering unloading a couple positions, but I haven't made a final decision. The good news is that almost everything in the market has been soaring recently, and that includes some of the stocks that I'm considering unloading. So I've been putting off replacing a holding or two for the new year to see what happens. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.